Welcome everyone to Econ to Action, our economic podcast series where we look at how businesses in different market sectors are navigating our economic environment. My name is Josee Farmer. I'm an economic analyst at Experian, and I'll be your host. So far in this series, we've taken a look at a range of market segments that I hope you were able to check out. But today's episode does obviously look a little bit different. We're in the studio today and we'll be hearing from not only one, but three market experts. And in the spirit of the new year, we'll be looking at the forecast for the rest of 2024 through both the lens of the broader U.S. economy, but also through the lenses of the three markets that we'll be diving into today. The hope for this episode is that it connects the dots between the market segments in a way that offers both new insights and a fresh dialogue. Of course, the landscape of the U.S. economy is going to affect different market segments in different ways. And we'll get into those specific differences, but first I want to set the scene with a look at the year ahead in the U.S. economy. I'm going to give you all a synopsis of the latest Federal Reserve forecasts for 2024 as of December. So the Federal Reserve releases their Summary of Economic Projections, or SEP, 4 times a year, where they compile the median forecast according to the Federal Reserve participants for 1, change in real GDP, 2, unemployment, 3, PCE inflation, including both headline and core, and then 4, the path of the Fed funds rate. So to get right into it, let's talk about growth. The participants forecast a median 1.4% growth in 2024, which is slightly less than the projection made in September and does represent cooling from last year's growth. In other words, we're looking at a slowing economy, but the magnitude of that slowing is not overwhelming. Participants are likely anticipating that slowing growth due to the expectation of moderating consumer spending. So consumer spending has been quite strong throughout 2023, but we should start to see more material effect on consumer spending from elevated rates and an easing labor market. Next, speaking of the labor market, we have unemployment. So for some background, the labor market remained strong throughout most of 2023, and only in more recent months has it started to cool. We've seen a moderation in job creation. For example, in December, the 3-month average job creation did dip below the pre-pandemic average. We've also seen quits return from their 2022 highs to pre-pandemic levels, signaling people have less confidence in the labor market and are consequently staying put in their jobs. All the while, unemployment does remain historically quite low at 3.7%. Looking forward into this coming year, participants do see unemployment easing a bit. The median forecast has unemployment rising to 4.1% from the 3.7% that it's sitting at right now. And that's the same as the last projection made in September and also their longer run forecast for unemployment. Next, let's look at inflation. So high prices have absolutely taken a toll on consumers and businesses alike, with outsized impact on lower income consumers. The latest annual PCE, or Personal Consumption Expenditure Price Index, came in at 2.6%, which essentially means that prices were 2.6% higher in December of 2023 than they were in December of 2022. Annual core PCE, which is going to exclude the volatile food and energy components, remains more elevated than the overall index at 2.9%. The Federal Reserve's goal is for inflation to come down to 2%, and Fed participants have PCE inflation, including both headline and core, coming down to 2.4% by the end of 2024 and then hitting that 2% mark by 2026. Lastly, what does all of this mean for the path of the Fed funds rate? Well, we've seen 11 rate hikes this cycle, making it one of the most aggressive rate hike paths since the 1980s. But we've yet to see the dampening effects on consumer demand that would be expected at this point. The good news is, though, as I mentioned, prices are still coming down. The participants project rates to come down to between 4.5% to 4.75% by the end of this year, which means 3 rate cuts from where rates are currently sitting. This is good news that the elevated rate environment seems to be on its way out, and a soft landing may be more feasible than we previously thought. So now that we've heard a bit about our current environment and where the Fed sees our economy heading this year, I'm very excited to hear from 3 different guests today, 3 client executives at Experian, representing fintech, collections, mortgage, and national bank market segments. Welcome Shawn Rife, Rollo, and Kendall Hellman. Thank you all so much for being here today. To get started, if you don't mind introducing yourself, telling us a little bit about the market that you operate in, and then the sorts of business partners that you work with. Kendall, we'll start with you.
Yeah, absolutely. Thanks for having me today. Super excited to be here. I'm Kendall Hellman Davidson. I've been with Experian for almost 11 years, which sounds pretty incredible to say I've been here almost a decade. I've had the pleasure of working kind of across the organization here at Experian, and about 5 years ago, I landed in the strategic channel. So I work specifically with the top national banks.
Awesome. Well, thanks, Kendall. So happy to have you today.
Thank you.
Shawn, we'll hear from you next.
All right. Well, Josee, first, it is absolutely a pleasure to be here. I'm Shawn Rife. I am the client executive for the Midwest Preferred. So essentially what that is it's a hybrid area where we over-index to the collections market, if you will, in particular debt buyers. And I also have a small smattering of regional banks and fintechs that are essentially driven by the underserved population. So definitely a fun territory.
Awesome. Well, thanks, Shawn. You know, you're our first recurring guest on Econ to Action, so really happy to have you here again today.
Thank you.
And then Rob, if you don't mind introducing yourself and telling us about the sorts of business partners that you work with.
Thank you. Rob Rollo, been with Experian about 3.5 years. I've been in the industry, mortgage, finance, fintech, data for about 20. My focus here within within Experian is the mortgage industry, housing industry, specifically the non-banks or independent mortgage banks, IMBs, helping them with prospecting, marketing, collections, capital markets, and servicing.
Awesome. Well, thanks, Rob. And thanks again for all of you for being here. So I did start us off with a broader U.S. economic outlook, but now I'm hoping to narrow the scope a bit to each of the market segments that you're representing. So Rob, we'll start with you on this one. As I mentioned in my summary of the SEP, rates are projected to come down this year. And so with that being said, as someone who works with partners from a more rate-sensitive segment, what's your outlook for business in the mortgage space in 2024?
I think it's a good, steady outlook is what we have for the mortgage industry. You know, the last couple of years were tough. With rates going up as quickly as they did and being a volume-driven business, a lot of consumers couldn't afford a refinance, which is what drove the previous boom, or they couldn't afford a home to begin with. Mm-hmm. So with rates now stabilizing, even coming down the last few months, we're starting to see a lot more applications. There's 55 million mortgages out there right now. Just with the rates dropping from 8 to below 7, there's 4 million consumers that can take advantage of that. Mm-hmm. Even from recent rates to rates that a little maybe they had before and they never did a refinance on. So there's a lot of opportunity out there. Also with the cost of living increases that have been happening, people can really tap into their equity, which has been growing. So we see with rates coming down, more people being able to afford new homes, people being able to refinance, take out equity, and take care of their more expensive credit cards, student loans, personal loans. So we have a good, solid outlook for the next 12 months.
Mm-hmm. Yeah, so essentially contingent on rates coming down as they're projected to, there's reason for more optimism in the mortgage space in this coming year.
Yes.
Kendall, how about the outlook for national banks? Is there the same level of optimism that Rob was mentioning?
There's definitely some opportunity for potential optimism. There's also some threats. I think for the top national banks in 2024, it's going to be a complex economic landscape, and it's going to be something lenders are going to have to navigate through. There's a few factors that I've considered for my segment. A lot of them came into 2024 with some strong capital positions. I think that was part of their strategy. They are gearing up for an impeding economic slowdown, a mild recession, so they want to buffer against some loan losses and potential defaults. With interest rates, right? You talked about it, Rob. It's big forefront of the mortgage industry, all the consumer's mind, and it plays a little bit differently into the other products outside of the mortgage industry. They are still going to be considered high, I think, despite some of the cuts. I think it's going to feel modest to consumers in 2020 compared to 2022 when we're thinking about credit card products or personal loans. And that has a double-edged sword, so to speak, for the lenders, right? They could profit off of some of those higher interest rates. But on the other side of that, on the deposits accounts, that kind of cuts into their margins a little bit. And it's going to be up to the lenders to get pretty competitive on how they grow their customer base with these high interest rates, getting some good 0% introductory offers out there to consumers, maybe on something like a balance card transfer if a consumer opens a new credit card. So things like that are definitely going to be stuff the top national banks have to prepare for. I am already seeing a few cuts though by the banks. So they are keeping a close eye on expenses. They are looking for what is essential, what is not essential, and trying to keep those operational costs down pretty low coming up this year.
Yeah, for sure. In summary, I think what you're saying, right, there's ups and downs, as I mentioned in the summary of the SEP, that could come into play in 2024 in our broader economy, and that those could translate into potential risks, but also potential opportunities for your segment. And then finally, Shawn, I know you're representing a segment with potentially a different outlook than the others. So what does 2024 look like in the collection space?
Yeah, it's interesting. I would call it a tale of two cities. So I know you're asking specifically about collections, but let me do point counterpoint.
Yeah.
All right. In your product hat that I used to wear, you're always advised to call it a little bit more off the cuff than normal. So I would normally say sanguine, but whether we're talking about the general lending environment or the collections environment, I've got to go a step further and say there's a lot of cautious optimism out there. So if we start very quickly, right, on the lending side, what we're seeing particularly on the underserved side is the idea that the American consumer has been absolutely unsinkable, right? We've gone through a recession, we've gone through inflation, we've gone through a pandemic, and there's been all these crazy world events, but yet and still, right, our delinquencies are fairly well in tow, and the consumer has been very resilient. So based off the strength of that, right, if we were to go back to right around the pandemic, the first thing that was happening, lending standards were tightened, so it was more difficult for the underserved consumer to get that first and second chance that they were looking for. So now we fast forward, right? And now we have that opportunity where we're getting maybe some of those interest rate reductions that we've been hoping for. It turns into a situation where essentially the lender can feel more comfortable, right? Lending now to the underserved population, driving those first and second chances. That'll have a ripple effect, we think, right? So there's that optimism. If we look at the collection side, right, I think it's possible to be optimistic there as well. And the reason I say that is, obviously the main things you're going to look at in the collection space are going to be number one, delinquency rate, right? And then I would say number two, roll rates. The idea that a loan has moved from one stage of delinquency into a further stage of delinquency, like so going from say 90 to 120, 180, and so on. Those have both gone up just a little bit, but certainly nothing like 2008. And so what we're hearing from our collection space is we're really optimistic about being able to work with that paper, but we want to make sure that we do it in a way that is auspicious and certainly something that is going to be above board in terms of prioritizing those specifically the people who can pay, as opposed to looking at it, just strictly from a dollar recovery perspective, right? Trying to get the most dollars relative to the placements that are out there. That's kind of taken a backseat to that kind collect, right? We had that conversation before, and we're seeing a lot more altruism in the collection space, and they're saying, hey, with Reg F that's out there, with a lot of the regulations that we've seen come down, and frankly, just our ability to leverage big data in a way that we never have before, we can take all of that data, make decisions we couldn't have before, pre-identify payment risk and the ability to repay, and prioritize based on each one of those different factors. So I think it's going to be a very good year, and I'm very excited about what we're going to see.
Yeah, amazing. Very, very well said. I think after hearing, all three of your different outlooks, there are some key differences, of course, but there's also a common theme of, I'll say, cautious optimism, as you said, Shawn. And I think that that's what really we're seeing from the economic standpoint as well. Growth continues to outperform expectations, including the last GDP release. And then on the consumer side as well, consumers are feeling a lot more confident about the state of the economy right now. The University of Michigan puts out a consumer sentiment survey, and that's been vastly rebounding in the past couple months. It increased 14% in December and then another 13% in January. So overall, consumers are feeling better. And that's really been driven by cooling inflation and expectations that inflation is going to cool even more in the coming months. With that being said, it'll depend how 2024 plays out, whether or not growth cools as much as is projected, and then also how consumers are positioned at the end of the year from both a financial standpoint And then also from a sentiment standpoint, that's really going to determine if over the course of this year, we see more of an emphasis on the risks that you mentioned, Kendall, or the potential opportunities. So building off of those outlooks, my next question, we'll start with you, Shawn. Sure. What sorts of solutions do you anticipate will become useful in your segment in 2024?
Yep. So again, wearing my product hat, when I was in product running scores, I had a mantra of what I called the 3 E's, right? Whatever we created, whatever we built, had to expand the ability to see consumers that we couldn't see before, right? So whether they were credit invisibles or other underserved, the idea is leverage data that expands your ability to see everybody, driving first chances. Second E would be enhance. The idea here is that there are people who we can see today using the traditional credit report, right? But what if we could enhance that so we could see a full 360-degree view of that consumer to now make second chance decisions that we might not necessarily feel comfortable with doing just based off of traditional credit alone. And the third piece is the E for ease of use. No client out there is going to use any of your solutions if it isn't easily integrated into her or his decisioning strategy, right? And so the reason that I led with that is I think there are going to be 2 types of data that are going to be particularly important because they accomplish each of those 3 E's. The first is really just assessing a person's ability to pay, right? And if we're moving into an environment now where we're feeling more comfortable about onboarding people we know to have higher risk, we want to make sure that we have that ability to enhance and expand our viewpoint, right? And so what additional data that comes directly outside of the credit report provides you is the ability to pre-identify payment stress, look at a person's ability to pay, and have more information than you would have had before, such that we can feel comfortable lending deeper, right? Understanding about a person's actual financial decisions before it even hits, right? The credit profile, right? Because one thing we talk about, like you were mentioning, unemployment, lagging indicator. I could actually make the argument that credit scores themselves are lagging indicators. And the stress that you would first see on a person's checking, savings, or money market account. Well, we have that ability to look at everything from forcible account closures to deposit, direct deposit history, to look at a person's ability to pay, see how that's changed over time, and make decisions we otherwise wouldn't or couldn't. And it is just as easily integrated as it would be with a FICO or a Vantage score. So that's the first thing, right? The second piece would be the area of optimization. We were talking about big data, we were talking about AI. The ability to leverage all kinds of swaths of different data is going to be extremely important, particularly to me, in the collection space, right? And the reason for that is if you look at where the collections are going in this country, it's number one, they're always trying to recover as many dollars as possible, but they're also trying to kind of generate another revenue stream in terms of just making sure that they're being as efficient as possible, particularly in the area of the call center. Well, we can now use big data to leverage data points that we never could before. Time of day, reach, the type of loan, right? Even the quality of the actual person making the call to the consumer who's giving either a robust letter of judgment or is using an automatic dialer. If we were to put all of that together, we can create an optimization strategy that will tell you specifically at the account level who you'd want to profile, right? Who you would want to prioritize, and ultimately come up with a rubric for maximizing that overall dollar recovery. So that would be my answer.
Yeah, that was great, Shawn. I really liked how you focused at the beginning on that first bullet point that you brought up about using different predictive factors outside of the credit profile and using those to achieve maximum results, but also in doing so, you're not compromising fairness. And I know that's something that you brought up during our Kind Collect episode, and it's a really cool application of machine learning, so really appreciate you bringing that up again. And then, Kendall, if you don't mind, what sorts of solutions, as they navigate the ups and downs in 2024 that you mentioned in your outlook, what sorts of solutions do you anticipate will be useful in your segment?
Absolutely, yeah. Echoing a little bit what Shawn said, optimization is definitely going to be useful for my segment. We're considering, right, all of the new competition that's going to be coming out, the volatility in the market, and ultimately consumers' behavior is going to change. This is going to create complex business problems that lenders and banks are going to need to be able to solve. And being able to do that in a mathematical approach in an optimized way is really going to be the best way to help them understand where they need to go to get that profitable and best decision to move forward and grow their portfolios. So I think optimization is going to be very powerful. Also AI, right? A big buzzword, but it's going to be valuable as well. Really being able to lean into analyzing that vast amount of data, the additional data that Shawn talks about, right? Bringing that in, analyzing it, understanding the impact into our portfolios, and coupling that with new innovative machine learning models to be able to predict everything in the customer lifecycle, from prediction and better prospecting, right, and response rates all the way to loan loss and defaults is going to be pretty important. And I think lastly, I'll touch a little bit on fraud. I think really investing in the fraud solutions is going to need to be a top priority. Fraudsters, fraud rings, they're ever evolving, rapidly changing, getting more sophisticated, prying on consumers and taking advantage of everyone. So being able to have a fraud analytical hub where you can go in, analyze, predict new fraud patterns, come up with new models to actually predict the fraud before it happens, and ultimately stop it before it happens is going to need to be prioritized.
Yeah, definitely. I'll pull out the fact that you have both now mentioned, leveraging AI, and that has definitely been a recurring theme on this podcast so far. I think that one of the reasons for that is that as our economy is shifting, we have continuously changing forecasts and conditions. It makes it even more useful to have accurate predictive ability, and AI does, allow for that. And then, Rob, what sorts of solutions in the mortgage space do you anticipate will become useful?
Yeah, I think there's going to be 3 areas, and AI is going to be one of them. It's growing into the space, but the industry as a whole really cut to the bone. Resources, dev resources, analytical resources. So I think there's going to be some opportunities using our unique combinations of data, property data, credit data, marketing data, and on an analytical level, do a bunch of peer-to-peer analysis, looking at their own portfolios, looking at their capital market space, on where they can spend their money smartly, protect their consumers, protect their portfolio, grow and expand their portfolio. Whether it's a bank or a non-bank, there's potential for cross-sell and upsell if they identify the right people at the right times. On the origination side, so kind of working backwards through the life cycle of a mortgage, there's still going to be a very strong need to reduce that spend, the origination spend, and keep it as low as possible. So leveraging a lot of our machine learning optimization tools, leveraging some of our verification, consumer-based and automated instant hit tools, using credit smartly, whether it's a tri-merge, bi-merge, or a single bureau, based on what's happening at the government level. I think those are going to be big places for people to investigate and really learn where they can help the consumer and lower those costs. But where I see the most expansion is going to be on the front end, the prospecting and marketing. Because it hasn't been forefront for the last year, and it's really been how do we keep who we have, and then it's more opportunistic. It won't be as much of a shotgun approach as it was a few years ago. I think it'll be more of a long-barreled shotgun. So just smarter targeting of the right people at the right time, using income analyzers, using ability to pay, using predictive models, propensity models. So that will lower your marketing costs, it'll lower your direct mail costs. Leveraging a lot of our modern contact capabilities with phone and email, they're going to be able to get the right offers to the right people at the right time, which is how we've been doing it a lot in credit card and personal loans and other divisions. For mortgage, we're catching up to that, and I think this will be the time for Experian and for the mortgage industry to really help out there.
Yeah, definitely. You mentioned prospecting and marketing tools, and that makes a lot of intuitive sense in a shifting economy, right? As lenders try to ID and obtain potential customers as accurately and efficiently as possible. Well, thank you so much for the insights so far. One final question as we're wrapping up. Kendall, we'll start with you on this one. I'm just looking for your final thoughts on how the coming year is going to affect your market segment, or in other words, where you anticipate your market segment will be 1 year from now.
Sure. Well, I haven't officially filled out my 2024 bingo card yet, so I know there's going to be something that, unpredictable happens. But overall, for the segment, I think we're going to see the continued complex landscape, and interestingly, how our lenders will kind of navigate to things that change throughout the year. I do predict that maybe from like a local branch perspective, we might see some branches close, right, as they're thinking about cost cutting and the consumer behavior changing. and not as many consumers going into the branches. Maybe by the end of 2024, we start to see some local branches close down. But overall, to be the most successful lender, right, in this kind of upcoming landscape and navigating potential mild recession, I think as long as the banks can adapt to change, manage their risk effectively, really lean into some of the innovations, and ultimately provide that customer experience that users need, they're going to be successful.
Perfect. Thanks, Kendall. Rob, how about you?
I see this as a year where the mortgage industry is really going to invest in itself. The companies that did really well last year had a good balance of purchase and refinance in their books, and before where people suffered where they only did one or the other. So by investing in themselves, I think there's going to be a lot of new technology that comes in that allows them to quickly shift and balance as the rates change, as the market changes, and be able to really leverage technology smartly to support the consumers, identify the consumers, and provide the consumers with what they want at the end of the day, which is a really fair mortgage rate so they can achieve that American dream.
Yeah, definitely.
Yep.
Shawn, how about final thoughts for your market segment?
I'd have to say for collections, I think it's going to be the year of what I call the great recognition. And what I mean by that specifically is there was a lot of fear amongst the debt buyers and collection agencies just because of the sheer amount of regulations that came on the book during the pandemic. Everything from, capping the amount of dollars, that you could actually collect on, to just a lot of uncertainty about if you even can collect on medical debt and collections. Now, there's been that recognition, but what there's also been is what Kendall and Rob are talking about, right? There's this now understanding and awareness that was not there before of AI, big data. So the ability now is there to have your cake and eat it too. It's not just about focusing on growing your business by maximizing dollar recovery at the expense of other consumers who maybe have too much payment stress to really be able to do the right thing. No, it's about leveraging information so that we can make sure that we're putting the correct offers in front of people, allowing people to get back to us so that we can maximize the overall utility of both the collectee and the collector themselves. Big data is going to help with that, and as we talked about before, optimization is going to go a long way in terms of just making sure that we can run our businesses more efficiently. So very excited.
Yeah, I think that was a perfect positive note to end on too. Thank you all for your insights so far. This has been great. And also thank you for your outlooks for 2024. Reflecting on those outlooks, I think that there are obviously key differences, but when we use the economic projections as a basis, there are definitely some common themes that we can pull out from each. But before we go, I do have some final rapid fire 2024 predictions to ask you all about. So here we go. Shawn, my first one, do you have a prediction of a movie sequel that'll be announced in 2024?
So you guys heard it here first. I think that there is going to be a sequel to, in this case, Succession, and it's going to be called Exasperation. And so everything's going to pretty much be the same cast of characters, right? For instance,
Sure.
Roman Roy is going to still be played by Kieran Culkin, but Kendall Roy will actually be played by Kendall Hellman. And so it's getting interesting, right? And so what we're hearing, Shiv is going to be played by Travis Kelce. And ultimately the patriarch, right? Mr. Roy will be played by none other than Tay-Tay. Taylor Swift.
Perfect.
Thank
I'm
you.
looking forward to it. Kendall, you're a foodie, and so my question for you, I'm looking for an in versus an out for all things food in 2024.
That's a good question. This might be weird to some people, but maybe some people have already started to try this. So, avocado toast, right, has been a rage for a really long time, especially, all the memes out there with millennials spending tons of money on avocado toast. But I think you'll see restaurants take that off their menu, and what's going to pop up is cottage cheese toast. I think we're going to see some savory cottage cheese on menus at restaurants. I think it's the new burrata, and it's going to take the food industry by storm.
I agree. Honestly, the protein content
Yes.
too, it's great. Rob,
How do you
about
follow that?
you right? It's hard.
You
Rob,
heard it here first.
You heard it here first. My question for you is your 2024 Super Bowl winner prediction.
Ooh, good timing. Well, I think San Francisco's got probably the strongest team that's out there. However, Mahomes and Tay-Tay have such an ability to just pull rabbits out of the hat. I'm going to put the money with Kansas City, but I see San Francisco giving them a really, really good struggle and a high-scoring game.
Awesome.
Yeah.
Well, you heard it here first. Very solid predictions all around. That was so fun. So thank you all again for being here.
Thank you.
Such an honor.
And thanks to our audience for tuning into Econ to Action. Once again, I'm Josee Farmer, and we'll be back with more episodes on new markets in the coming months, so stay tuned. Thanks again. Bye.